I'd like to thank everyone for coming out tonight. It's nice to see a good group in the audience, because without you, the presentations really are for nothing. So thank you for coming. I'd like to introduce our speakers this evening. So our panel consists of Gavin Miranda, who is a CPA, CA, and a partner of taxation services at MNP's Ottawa office. Gavin has more than 17 years experience helping public and private companies with their tax compliance, tax consulting, and tax provisioning needs. He has worked with clients in both restaurant and hotel industries, assisting them with their business models and domestic and international tax considerations. Gavin also has in-depth tax compliance experience, working with teams internationally to coordinate and deliver tax compliance services to large multinational corporations. We also have on our panel Chad Saikaley, CPA, CA, TEP, and he's a partner and head of tax at GGFL. Chad specializes in tax, estate planning, and corporate reorganizations. He works with a diverse client base and provides a wide variety of services to businesses and business owners in countless industries. He enjoys getting to know his clients and their business as well, so that he truly understands their needs and challenges. And last but not least, we have Dean Blachford, and he's a tax litigation lawyer with HazloLaw Business Lawyers. He helps people and businesses who are facing significant tax disputes obtain the best results possible as efficiently as possible. Dean co-authored the chapter on evidence for the Thomson Reuters Tax Disputes and Resolution Center, and is recognized as an expert by TaxNet Pro. He is a guest lecturer at the University of Ottawa Faculty of Law, and prior to entering private practice, he completed a judicial clerkship at the Tax Court of Canada. So I'll turn our evening over to our three panelists.
Thank you very much, Pat. Thanks everyone for joining us today. So Chad and I are going to go back and forth on some of these changes, and we had done this presentation and sent it over to Dean yesterday and finalized it and everything like that. And then lo and behold, this morning we got a notice saying there was a notice of Ways and Means motion that came out with legislation. So both of us were a bit scrambling, trying to figure out is there any changes that we need to be aware of and make changes to. But thankfully, I don't think that there were too many. But if you guys have seen anything, then by all means, let's have a discussion about it too. So without further ado, let's get rolling. So, as we all know, I mean, the TOSI rules were initially only applicable to those that are under 18 years of age. And they applied to dividends and business income, related party dispositions on CCPCs. So, that was pretty narrow. And then July 18th came, and I know everyone here got a big shock. We did as well. With applying to all Canadian residents, no age threshold, who receive income from a business, unless these exclusions are met. So what happened with those rules? Those rules expanded to include income from indebtedness. They expanded to include gains from the disposition of property, and income that was conferring a benefit, or 15-1 income as well. So just to be aware now, the default is TOSI applies first and foremost unless you meet one of the exceptions. So right off the bat, you're in TOSI rules if you receive, for example, dividends from a private corporation. And then you have to go search to see whether or not you meet one of the exceptions and exclude or not. So just to give a bit of background, then in December 13, we recited revised legislation. And this is obviously not yet enacted. We have to go through, the reading, and today's notice of Ways and Means motion obviously brings us to close to first reading. Certain aspects of this are complex and they're subject to more interpretation. I think the Joint Committee's made some submissions on it, which you may have seen. And the good thing is that they did introduce some bright line tests. The first version that came out in July left a lot of uncertainties. At least in the December version, we saw some clarification and some bright line tests that we think that, at least there's some relief there. The CRA had released guidance on how TOSI will apply to adults, and we'll talk about that as we go through this. And one thing that we obviously see is that, the government has focused on distinct groups of people. So obviously there's the minors that have always been caught, but now they've also looked at the category between 18 to 24 years of age and then 25 and plus. So the 18 to 24 was obviously those university students that were getting the income to use their marginal brackets, go to school, those kinds of things. So they really thought in doing their analysis, if you look at the policy paper, that that was also being abused. So now we have what I think is a new framework to analyze TOSI. When you analyze TOSI, you got to look at, is there a specified individual? Is there split income? And then, is there an excluded amount? So that's the way I think of it. So who is a specified individual? Well, basically now, a specified individual is anyone resident in Canada. So anyone really is a specified individual. And is there split income? Well, split income is taxable dividends on shares, not public company shares, private shares. And indebtedness. But it doesn't include, or it could be capital gains, where it's not a QSBC. So dispositions of property, indebtedness that's added in is split income now. So if that's the case, then how do you get out of it? Well, you have to get out of it by saying, do I have an excluded amount? And there's several different definitions of what's an excluded amount. One of the things in the excluded amount, they included these bright line tests that I mentioned. TOSI will not apply where the person that ran the business is 65 years of age or older, and their, for example, spouse gets dividends. If that person that receives the dividends, even though they may be younger than 65, if that dividend had been paid to the older spouse that was 65, and it's not TOSI to them, so they meet one of the exceptions that we'll get into in a second, then that's excluded, and it's not going to be TOSI anymore. So that's one of the safe harbor provisions they brought in. That's akin to some of the pension splitting that's already in place for seniors and things like that, to put them on a level ground. Where capital gain qualifies as QSBC, it's not going to be TOSI. So that was a relieving provision that came in that I think most people were glad to see. And also they brought in when the shares are inherited. So if you inherit shares from a person, and you basically step into the shoes of that person from who you inherited those shares. So anything with the dividends paid on those shares would have otherwise qualified for an exemption or not subject to TOSI. Then you would have also fallen into those same exceptions and carry on going forward. So additional exclusions were also included to limit the application of the new rules. To provide for the application of the new rules. What were they? So the TOSI, as I mentioned, where dividends are paid by a private corporation. Let's focus on that for a second. When you say, most people here are worried about dividends, income sprinkling, and situation. So let's use that as an example. So it's paid from a private corporation, directly or indirectly, to an individual from a related business. And that's a new term that you have to be aware of. What is a related business? In respect of the individual, then the TOSI rules are going to apply, unless it falls within a specific inclusion. So, if amounts were received from an excluded business, then you're not going to be into TOSI. And that's a new definition you have to be aware of. What is an excluded business? The income or taxable capital gain was from the disposition of excluded shares, which is another definition that we're going to get into. And what does that mean? So if you have excluded shares or ownership of certain companies, that will exclude you from TOSI. And if you're failing those two tests, you can also argue, do you have a reasonable return? And a reasonable return is categorized between those two groups that I talked about, 18 to 24 and 24 plus. So a related business, just to be aware, if you receive a dividend and it's from a related business, that's a business where a related individual, so spouse receives a dividend from a business that's run by their spouse. Spouse A receives a dividend that's from a business that's run by spouse B. Well, in that situation, the related individual, spouse B, is actively engaged in the business on a regular basis. So that dividend to the spouse is going to be TOSI. If the spouse owns greater than 10% of the votes in the value of the company, or the fair market value of the corporation, and their spouse, so spouse A owns that 10% or more, and spouse B also owns shares, if spouse B gets a dividend, that's going to be TOSI, because it's from a related business. So that's the threshold test that we're talking about. So what is an excluded business? So again, we're in TOSI, prima facie we're in TOSI. How do we get out of TOSI? You have to fall into one of the exclusions, one of which is excluded business. So an individual will be exempt from TOSI if, and this is another bright line test, they work more than 20 hours per week in the current year, prorated for if the business doesn't operate throughout the year. There's factors such as maternity leave that can be taken into account, sickness, illness, those kinds of things are also provided for. So that's the test of 20 hours per week that someone does. Or if someone has met that test in any 5 years in the past period of time. So that doesn't have to be continuous, that just looks back. And has that person worked in the business for 5 years? It's looking back, and it's the individual that you have to refer to. In the individual's taxation year when they receive that income, can you look back and say they worked in the business for 5 years, in any 5 years? And then the test is met for your lifetime. You don't have to worry about it going forward. So that would help if someone was active in the business, then retired, but still had shares in the business. They've met that test, and so dividends to that person will continue to be exempt from TOSI going forward. So there's still some uncertainties as to how to apply excluded business, and we'll see that some of them coming up. But excluded business is generally a good thing. Right? The other exception is excluded shares. And excluded shares applies when the person is 25 years of age or older. And they own 10% or more of the business by votes and value. The other two tests or a couple of tests that need to be met is, this only applies if less than 90% of its income is from the provision of services. So when you think about it, today's economy, our service is primarily a service-based economy. So it's going to be very hard for a lot of companies to meet this test. And why have we carved it out from a policy perspective? I'm not sure, other than to say that the government wants these rules to apply, therefore they've carved out services business. So if you're in the manufacturing business, or if you're in the distribution of goods business, then you could potentially qualify for being out of TOSI. Now there's things like, what if you're a trucking company? Is that a provision of a service or a provision of goods by transporting the goods? So there's still ambiguities when you talk about what is a provision of service. It also seems unfair that you would think about a provision of service that if someone operated a pizza shop, then they could meet this criteria, they could meet these tests if the spouse had 10% or more of the business, and that would be fine to income split. But someone that operated a hair salon, which is a service business, would not be eligible to take any advantage of these TOSI. So what's the distinction and where's the bright line, or the rationale for that? Obviously, it can't be a professional corporation. I think that message comes loud and clear from the government, as we've seen over the past couple of years as they continue to crack down on professionals. And less than 10% of its income has to be earned from a related business. So in one of the clarifications that came about today, in today's notice of reasons motion, is that they talk about that 10% ownership test as 10% of the votes in value, own shares worth 10% of the votes in value. So in the earlier version of December 13th, it specifically referred to the shares having 10% of the votes in value. Or that's the way I think most people interpret it, or certainly as I did. Which meant that when you had split shares, where you had votes and value split between two different classes of shares, the share that the dividend was paid on had to have both the votes and value. So reorgs were going to have to be undertaken for this purpose. But now, when they were akin to more to the connected test. And so now you can have 10% votes or value in different shares. So with that, going again from the TOSI rules, you're in TOSI unless you meet one of those exceptions, being, is it an excluded business, or is it excluded shares, income or gains from excluded shares. And if passing those two, then you have to meet the test of, are you earning a reasonable return? And I'll turn it over to Chad.
So at this point, for the reasonableness return, you're in deeper waters. So the way I sort of look at it is, you start off with, the most favorable exclusions, and then you get lower and lower on that golden rule. So, you start off with excluded amounts, a lot more straightforward. You get into, the bright line tests with the 65 plus rule, and then you have the, one of my favorites, because obviously if you can't meet the 65 plus rule, is the excluded business, because if that was met in any one of the previous 5 years, then you're set. So from there, you get down to the excluded shares, as Gavin was saying, and now you're in reasonable return. So I think this is the section that's going to probably keep the potentially new Hamilton tax court busy, because this is where again it's not as clear cut. So for the reasonableness test, it's really important, and Gavin did mention this, but just to make sure that people are clear, when you're looking at the TOSI rules, you have to consider it in terms of, I look at it as sort of three different age groups. You've got your 18 to 24, and you've got your 25 plus, but then you've got everyone else, okay? So you always got to sort of think of it that way and what applies to the different age groups. So for the reasonableness test, they have two distinct tests that are just for the age category of 18 to 24. And one is the safe harbor capital return. And basically what that is, in other words, is prescribed rate of return on the value contributed. And also one of the things I do want to point out is, again, in this age category, these reasonableness tests are based solely on capital contributions, okay? So it's not in terms of contributions other than capital, such as risk or actual work performed or whatnot. So I guess the twist for the prescribed rate of return loan is that it actually applies with the highest prescribed rate for a quarter in the year. So if the rate's going up in the year, we're all expecting that to happen this year, actually in April. So that highest rate will apply. So if you think about it, you really don't want to rely on that, because let's say you're going to have a child between the age of 18 to 24, potentially put in, let's say, $2 million, and if the rate does go up to 2%, then that's $40,000 that you could give them. But then meanwhile, you're probably putting the company offsides for the qualified small business corporation shares. So you want to make sure that hopefully you're falling into a different test. And then the other one is the reasonable return on arm's length capital, which is another new term, which is basically capital not received from a related person or even through a loan. So they would actually have to come up with their own capital, invest it, and look for potentially a market rate of return. All right, so if they have $500,000 somehow, they'd have to invest that and maybe look for prime plus 1 or 2, depending on the nature of the business. And then we move on to the reasonableness test for individuals aged 25 and up, for everybody else. And so this is actually based on contributions of the specified individuals relative to contributions made by primary business owner, including, and I've got the list up here, and this isn't an exhaustive list, but they look at work performed in support of the business, property contributed in support of the business, risks assumed. So, for example, if they're acting as a guarantor for one of the loans or lines of credits, total of all amounts that were paid or that became payable to them in respect of the business, and such other factors as may be relevant. So, as you can see, if you were really relying on this, then you're going to want to make sure that you've got some strong documentation and what is acceptable and what is not acceptable. Other changes with respect to where we started with the July 18th proposal to where we are now. So TOSI will not apply to compound income, which is great, or income derived from property acquired as a result of a marital breakdown. So that's good as well. That wasn't necessarily the case before. Aunts, uncles, nieces, and nephews will not be considered related individuals for purposes of the TOSI rules. So again, that's positive. They also confirmed that the broad rules countering conversion of regular income to capital gains has been abandoned. So what are the remaining uncertainties? Because there are some. And actually, when these came out initially, December 13th, 2017, we sort of looked at this and said, okay, I mean, there's a lot of unanswered questions, but hold tight. When the budget comes out, we should have some more clarity. And so the budget came out, and unfortunately, they didn't provide any further clarity. They basically said that they're going to be sticking with the proposals or what was released back in December. So really, Gavin mentioned some of this, but what is a service business? We're really going to hopefully get some guidance on that, because that is sort of open to interpretation. Could shares of a holding corporation qualify as excluded shares? So Gavin, again, touched a bit on that as well. But basically a common structure where you've got OpCo owned by HoldCo, and you've got the shareholders owning shares of HoldCo. Again, if the dividend is coming up from OpCo, you're not meeting the excluded shares exclusion. So maybe the key shareholder who's actually working in the business meets the excluded business exclusion, but for all the other shareholders, you would not. But again, I mean, is that what is intended or not? But with today's notice of Ways and Means, becomes a bit more clearer. Related business. So, what is the interpretation of actually carrying on a business? So, is an investment portfolio, for example, that's held in a corporation, a business? So, the Income Tax Act, the subsection 84(2), interprets business as including holding investments. So, in that context, the word business is not qualified by the expression carried on, which could justify a narrower interpretation. So again, not too clear. We also have inherited shares. So I found it, I wasn't too sure why I guess for inherited shares, they had a specific exclusion for individuals aged 18 to 24 in the definition of excluded amount, which is a very key term and definition within the TOSI rules. But for individuals 25 plus, you had to go to another section within the release rules, and basically it's almost like a backdoor into saying that the individuals 25 plus will not be affected by inherited shares. So again, it's not something that I'm concerned about, but something that is that we're a bit curious. And then again, supporting documentation. This is key. I think we're going to have to rely on this very much so, especially for the excluded business exclusion, as well as any other reasonableness tests. So, and that's again, what is enough? What is sufficient? And I'm going to pass it on to Gavin, who's going to start going into some of our examples.
So I thought this one, the first one, we talked about, what is income from a related business? So in a situation where income from a related business is bad, because if someone that is related to you works in the business and you receive a dividend, then that income is going to be toasted. So let's take a situation where you have a sole shareholder of OpCo, owns all the shares of OpCo. The sole shareholder is a specified entity. That's a person resident in Canada, remember. The sole shareholder receives a dividend. So is that dividend received from a related business? So a related business is one where a related individual works in the business. So there's case law that could say that says that you're related to yourself. So if you are related to yourself, then that dividend to you is TOSI. So if the dividend to you is TOSI, you don't meet the income is now not derived from a related or derived from a related business. So you're in it. You're also active in the business, and you own greater than 10% of the shares. So then it is still a related business to you. So you don't meet that exclusion. You are in TOSI right now, and you have to say, how do I get out? And obviously you get out by saying it's an excluded business because you're working in the business, you presumably are working more than 20 hours. But I thought it was interesting that you could actually be the sole shareholder of a corporation and be in TOSI. So what about another situation where, let's say the husband and wife are worked in OpCo at one point in time, and spouse one left, but spouse one still has a share ownership in OpCo, less than 10%. So let's say 1% in this example. Spouse two is employed by OpCo, actively engaged in the activities of the corporation. So spouse one receives a dividend. Spouse one is a specified individual. Because spouse one is a specified individual, we have to see if it's from a related business. Is the income derived from a related business? Well, spouse two is related to the spouse one, obviously, and works in OpCo regularly. So now that dividend is from a related business. So that dividend is split income, and the exclusion isn't met. So another example for excluded business. So spouse one founded OpCo, founded and operates a construction business, and is a property management business in OpCo. Spouse 2 works 25 hours per week in the property management business. Spouse 1 and spouse 2 are both specified individuals. Spouse 1 and spouse 2 are both source individuals in relation to each other. So, what are the concerns? Well, excluded business definition rather, says that a business applies to a business and not a corporation. So you have to look at each business that's there. So do we have to trace the full funds from the property management business if it gets paid to spouse 1? If the construction business profits get paid to spouse 2, do we have to trace it? They don't work in that business, but it's only related to that business. Are you supposed to take an aggregate approach of the 20 hours of they work 20 hours in the corporation? Because there's multiple businesses going on here. So are you tracing and streaming to each of those businesses? Do you then need to have, in some instances, you have tracking shares that track to the business. Are you supposed to only own those shares that track to the profits of the business? So that's some of the concerns that I think come into play when you're looking at this. And today's Notice of Ways and Means motion didn't clarify any of this in terms of how do you track if you have multiple businesses in a corporation and spouses are working in different businesses, or brothers for that matter operating different businesses. And if one brother works in business A and the other brother works in business B, then the construction or property management business example, how do you streamline and track those two? So I think this is the example that Chad also mentioned. So spouse 1 founded and operates a hot dog stand, so it's OpCo. It's not a services business, so it's not a related business. Spouse 2 is not involved in the business. Spouse 2 is a specified individual because they receive a dividend. Spouse 1 is a source individual with respect to spouse 1. So the concerns, the income of HoldCo is derived from OpCo. So that's a dividend, and it's from a related business of spouse 2. Spouse 2 shares of HoldCo cannot be excluded shares. But if spouse 2 held the shares in OpCo directly, you would have an excluded business. But because that dividend was paid up to OpCo, that income is derived directly or indirectly from a related business. So OpCo again is a hot dog stand. Let's say that OpCo was a hair salon. Hair salon sells products and it sells and it provides hair services. So that 90% test that we were talking about before, where 90% of that revenue has to be from the provision of services, or not less than, if it sold 10.1% of its revenue was from the sale of goods, now all of a sudden you don't have a related business. And so dividends can go out without being toasted. So it's kind of, what is the arbitrary 90% getting at here? The other thing in today's Notice of Ways and Means that clarified something is, if there's an example where, father owns business A, that's I think the joint committee put it in, it's a manufacturing business. And the other spouse owns a business of catching, or sourcing the parts that sells over to the manufacturing that then does the work in the manufacturing and pays dividends out to father, and let's say daughter's also in that business. Daughter's not actively engaged in the manufacturing business. What was happening is, because the business, the profits of the manufacturing business were related to the business that mother owns, so it's a second company, the dividend that was paid to the daughter was captured under TOSI. But though they were both active businesses, they were not provision of services, they were actually manufacturing businesses. So today's Notice of Ways and Means motion says, well, if you receive that dividend or you receive your income from a related business, as long as that related business isn't in the provision of services, but it's from your own operation, i.e. you are manufacturing and selling, then that dividend that went out to the daughter who's inactive in the business is okay. I think I'll turn it over to Chad for the next example.
So just one other example for TOSI. This is another structure that is sort of commonly seen. And just to break it down, we've got child one, who's worked in the business at least an average of 20 hours per week during the year and receives a salary. Child two does not work in the business. Parent A is 7 years old. The shares are owned by parent A, are also redeemed annually. All right, so this is common. A dividend is paid annually to the family trust and distributed equally between child one, child two, and parent B, who is the spouse of parent A. So how does this apply? How does TOSI apply in this scenario? TOSI does not apply to the dividend received by parent A from the redemption of shares due to the excluded shares test, okay, that bright line test, but it may have even been the excluded business test, all right, but the excluded shares test is pretty clear. TOSI does not apply to the dividend received by parent B because parent A is over 65, and the dividend would be an excluded amount if received by parent A. All right, again, this is going back, so this is saying you meet this test if, in this case, parent A is over 65 and would have been able to meet a different exclusion or exclusion on its own. And again, we already said that due to the excluded shares or maybe even the excluded business, it would have been okay. So now their spouse is okay. Child one is deemed to be actively engaged in the activities of the business because they worked in the business at least 20 hours per week for that year. Therefore, TOSI does not apply to the dividend received by child one, and TOSI also doesn't apply to salary. TOSI, however, will apply to the dividend received by child two in this case. All right, so we've gone through some examples. So what are some of the answers to these uncertainties that we're sort of hoping for? But really at the end of the day, we're looking at it and we're saying, sure, there's some improvements, but a lot of taxpayers that were initially impacted by the changes are still affected. Okay, so it's funny because a lot of people are sort of seeing this and saying, thank God these are a lot softer than what they were supposed to be. But really, let's look at June 2017 to December 2017. All right, so there's still certainly improved, but still a lot of our clients, as well as us, were being affected as well. So the other thing is, again, no definition of the provision of services. I'm really curious to see how this is addressed, if at all, and possibility to apply to a large number of businesses, not only to the professionals, as well as an obvious increase in the administrative burden on business owners. All right, so what do we do? So some planning considerations. We're really going to need to look into this for each and every one of our clients to see, first of all, should we even be concerned of taking advantage of any of these dividends to family members? But really, as I mentioned before, one of the key exclusions is the excluded business. All right, so let's determine first of all if the excluded business exclusion will apply to the business. And so consider how long are these family members working and how much are they actually contributing? And are they really close to that 20 hours per week minimum or that average? And if they're close, are they interested? Are they able to? Are you able to provide them or give them further responsibilities to get them to that mark? Again, if they could meet that, even when they're younger and before they're fully graduated and have another full-time job, and if they've done that for 5 years, then they're set. They're set for basically for as long as you've got this structure in place and the business in place. So some conversations to have there. Have any of your family members worked an average of 20 hours per week? So even if it's not currently, go back to, let's say, a spouse that is no longer working in the business but may have for an extended period of time before in the past, and therefore they'd be okay. I guess the exclusion that's going to create a lot of work for us and take a lot of our time is this other exclusion for the excluded shares. Because for that, we're going to have to consider if we need to do any sort of reorgs for our clients. And one of the things that they're saying for the TOSI rules is they're saying, okay, the excluded shares test would have to be met immediately prior to the payment of the dividend, or in 2018. So what that's saying is, going forward, after 2018, if you want to pay a dividend, you can't do the reorg if one is required after that was paid. It would have to be immediately before. However, for 2018, you could pay that dividend right now, all year, and they're giving us time by the end of this year to make sure that we meet that exclusion. All right, so there's a lot of things that we're going to need to consider here. So, for example, considering distribution of shares to individuals in order to meet the direct holding requirement. I've had some really interesting conversations with clients on this. And the interesting thing is, if you look at it, you're saying, okay, you're paying dividends out to spouses and children, all right? But you basically say, look, if we want to continue this, and assuming the other exclusions don't apply, so if you want to continue this, we may actually have to potentially hinder the estate plan that we put forward and that we set for you, and have the trust allocate shares directly to some of the beneficiaries to make sure that they meet that test, that excluded shares test, because that's 10% or more of the votes in value. So do you really want to do that? And in the conversations, it's funny, conversations that I've had for children, they actually didn't. Because, there's a finite amount of time that you could actually income split with children, right? So what's more important? It's a bit of a give and take, so you really need to have that conversation, have that documented. Consider a freeze, potentially, that you may need to distribute fixed value shares to the individual beneficiaries. So, this is great. We could allocate shares directly from the trust out to the beneficiaries. We could do that, give them the votes that they need, but do they even have the value? So we may need to do a bit of a freeze and then give them free shares. Okay, so again, valuation potentially required. The other thing too is, do we even have these shares available? So we may need to amend the articles, all right, and do a bit share exchange or a few other different options. So. And then again, we want to consider the age of the beneficiaries. As I said before, it's very key when you're looking at TOSI to look at 18 to 24, 25 plus, and then everyone else, or everyone together. So I think that is going to take up a lot of our time, this year especially, and we're going to need to have those conversations. There's also, again, if a holding company is involved, how are we going to play with that, right? So Gavin was sort of talking about some of the uncertainties there if you've got a holding company, right? And so if we want to play around and move some of those shares around, what are other things that we may be giving up? So I already talked about some of the estate benefits that we don't want to necessarily affect, but maybe there's creditor protection, maybe there's family asset protection, protection from family law. You don't necessarily want to be giving shares out directly to a child. That could sort of be open to maybe a potential marriage breakdown. So a lot to consider. Going down, I guess I sort of touched upon this use of family trusts and holding companies. So really, I think what's important is that you have this discussion. First of all, why do we have this family trust? Was it for tax reasons only? Was it for estate planning? Was it a combination? How much weight are you placing on what these reasons were, and sort of really having that understanding. So to me, and I'm a TEP as well, I work a lot with trusts. I think they're still of tremendous value. So, there's a lot of really good reasons to actually still have them there and make sure that your clients are understanding of that. The other thing too is, people can still get dividends out through a trust and meet one of the exclusions. Still, with, for example, let's say going back to the 65 plus exclusion, and if it's a spouse getting a dividend through the trust, because they're, the main shareholder, let's say, is over 65 and met one of the other exclusions, then the spouse is okay. So, it's not as though if you get a dividend from a trust, it's, you're in TOSI immediately. Consider retirement planning, right? So sort of talked about that 65 plus, and then explore alternative strategies. So we always had this before, but going back to it, kiddie tax does not apply to salaries. So one of the things that I was saying is potentially when in doubt, pay a salary. So it's TOSI does not apply to that, and kiddie tax does not apply to that. You still obviously have to make sure that you're paying a reasonable salary. Spousal RSPs for income splitting, pension income splitting for an individual pension plan. So there's still other things that you certainly want to consider. I'm gonna pass it off to Gavin. So we're done with TOSI. We're on to the passive investments.
Thanks, Chad. So, passive investments, I guess, July 18th, when that came along, the passive investment rules, everyone took with the white paper saying, my goodness, we're gonna have tax rates of 72% coming out through investment income in the company. So everyone had, real fears as to what the government was trying to do and where they were gonna get to. In December, they announced, they'll release legislation in the budget that will give a $50,000 threshold. And I think what we saw in this budget was a welcome sign of relief. I mean, it's not perfect, but at least it doesn't hurt as much as what was being proposed before. And I think, honestly, it makes sense. It's easy to administer in the sense that it's measurable. They put rules around it that you can follow, that you can interpret. And I think it's a much more reasoned measure for how we're going to deal with passive investment income going forward. So, the government was concerned that the corporate deferral provided an unfair advantage. So, the corporate rates are significantly lower than the personal rates. The personal rate was there because the small business rate was there because they had less access to capital. Therefore, having a lower tax rate allowed them to get greater access to capital, and therefore the small business rate made sense. We had a certain amount of capital then, and now they're saying $50,000. If you earn investment income in a company or an associated group that exceeds $50,000, then you're going to start to grind on your small business deduction. And the grind is $5 for every $1 in excess. So CCPCs get $500,000, we all know that currently. And then now, for corporations, there's a phase out between $50,000 and $150,000 of investment income of the associated group. And so when you do the $150,000, so you get $50,000 free, that's $100,000. 5-time reduction for every dollar over eliminates your small business deduction at $500,000. And I think that, again, that's good in my opinion, only from the perspective of if you have that much capital sitting in your company, then you don't have a restriction on access to capital, and you can use those funds to generate other income. So I think, in my opinion, it's not an unreasonable measure, but again, it's not that it doesn't hurt. And so this is applicable for taxation years that begin after 2018. So it's an annual test for passive income in a year, looking back to the prior year of the associated group. So for 2019 years, whether or not you get the small business deduction is going to be relevant for what happens in 2018 if you're a calendar year taxpayer. They introduced the concept of adjusted aggregate investment income. And so this adjusted aggregate investment income is essentially interest, dividends, capital gains on investments, non-active rental income, which would otherwise do, capital gains and losses from dispositions of property, dividends from non-connected corporations, okay, and income from savings in a non-exempt life insurance policy. So some of the things that are excluded from aggregate investment income: assets used in an active business. So shares or dispositions of QSBC shares will not fall into aggregate investment income. The dispositions of assets used in an active business will not fall into aggregate investment income. And obviously interest in certain partnerships. So if you sold, your building that you used in the practice, or if you're a professional or a medical professional NPC, you sold a building that you had in your practice, you're not going to be in aggregate investment income for that piece of it. So with that, they announced additional changes as well. So that's regarding refundable dividend tax. So refundable dividend tax, as we all know, is a prepayment of tax, and it's paid on investment income. When the corporation pays out a dividend, there's a dividend refund to the corporation of 38 1/3 cents for every dollar paid. So what was happening, obviously, was people were creating what I call mixer corporations, or there's a mixer where corporations that had refundable tax and other businesses that had GRIP, you could use the GRIP to pay out, which is taxed personally at 39%, comes out of eligible dividends or high rate tax, 26.5%, tax rate. They would pay that to the individual. The individual highest marginal rate on that was 139%. But the corporation got a refund at 38% roughly. So that was a benefit because you were getting a lower tax rate overall for the investment income that you paid. If you paid an ineligible dividend to get that refund, your personal tax would have been in the 45% and now 47% roughly range. So what they've done now is segregated the RDQH pools into two pools. One that's an eligible RDQH pool and one that's an ineligible RDQH pool. And what this is, and talking to some other people, is just alignment of what they really should have done in the beginning. That when they created an ineligible regime, an eligible regime, they should have segregated those two pools to begin with. So going forward, you have an eligible RDQH pool and an ineligible RDQH pool. How do you transition that? Well, when you transition, it's the lower of 38 1/3 of your GRIP balance and your existing RDQH pool will go into your eligible RDQH pool. So that's what's going to happen going forward. And your eligible RDQH pool will consist of Part 4 tax on eligible portfolio dividends. So for example, if you received dividends from Bell Canada as a portfolio investment and paid tax on that, that'll go into your eligible dividend pool because it was an eligible dividend that was declared to your corporation. So now when you pay an eligible dividend, you can use that to get a refund from an eligible dividend pool or an ineligible dividend pool. Either one will work. But if you pay ineligible dividends, the only refund you're going to get is from an ineligible dividend RDQH pool or ineligible RDQH pool. So again, that begins in taxation years after 2018, and that may limit the type of dividends that you pay going forward. One of the things to think about is what you should be doing in the current year for various things. So there's no grandfathering. When they initially talked about all of this stuff, there's no grandfathering for capital that was already there. So in the passive investment income regime, 50,000 that's the limit. If you had existing capital before, it's not new capital that gets subject to 50,000. It's just whatever capital you had is going to be ground by the 50,000. There's more complexity going forward because you now have to track two pools, eligible and ineligible pool, but I think that's, again, a reasonable thing. But it's a significant improvement from the 2017 proposals or white paper that came out from the government. And some of the things to consider for 2018, I mean, I've heard people say, well, maybe you should sell and realize some capital gains this year. Well, if you do that, then one, it's still going to impact, if you take a lot of gains this year, it's still going to impact you next year. But if you're selling it, you're actually prepaying tax as well. So do you actually need to sell it and create that tax liability? Because some people say, well, let's do 50,000 every year to use up our minimum threshold so we don't have as much of a grind. Again, you're prepaying tax if you go to do that. Planning for 2018 and the other year. So this is, again, an associated group test. So you should look at whether or not you're associated. So if you have a husband that owns a business and their own company, wife that owns their own business and their company, but they collectively own an investment company that pools the funds from both of the businesses, well, those corporations are now associated with each other. So if you were to break and each of them have their own holding company, then you each should get a $50,000 threshold for your investment income before you start to get the grind on the small business stuff. So that's something else to think about. Some of the other, Some of the other quick hits on the budget highlights, I think the main thing is, the reporting obligations for trusts, effective for, tax returns filed for the 2021 and subsequent taxation years. Only certain trusts are exempt, very, very limited exceptions. But one of the things that I know that's when I saw it's going to be onerous when you have to file those trust returns with your trust members is listing all of the beneficiaries of the trust. So now you have to include all of that information as well when you file your trust return. So that's going to be a lot of work. There were no changes to the tax rates or personal tax rates, which was good, other than, you have to worry about your ineligible versus eligible dividends. And the federal government confirmed that, the rate is going to be 10% for small business going forward and drop to 9% in 2019. But, and finally, you know, they're still gonna run a deficit, and that's gonna be the story for the next couple of years, and we'll see what happens after that, whether or not we continue on in running deficits with the current government, but we won't get into politics. So with that, I'll turn it over to Chad for changes to WIP in professionals.
Yeah, so these rules are going pretty much after us. You know, they came out with these rules initially, not too, I guess maybe over a year ago, year and a half ago, but there were still a lot of concerns because of the short transition period. And so, again, in December, just this December that passed, they came out with some changes to what they originally came out with. And so, the big thing, so I guess looking at WIP to begin with, right? Everyone here, probably has WIP and works with WIP. So, professionals will no longer be entitled to, unfortunately, to elect to exclude their WIP from their income. And, so what is the effective date for this? If you're working on a calendar year basis, it's actually this year's the first year. So it's going to be December 31st, 2018. And if it's an off-calendar business, it's basically the first fiscal year that starts after March 21st, 2017. And so the professionals that are affected by this on paper are lawyers, accountants, dentists, medical doctors, veterinarians, and chiropractors. But in reality, the professionals that are really affected by this are accountants and lawyers who actually tend to have higher WIP. And the transitional period, so this is, again, good news relative to what it was before, because now the transitional period is 5 years. And so, that helps obviously diminish the impact to these professionals. And it's basically, comes in 20% per year. All right, so, that's something that, again, is much less than it was before, and this is obviously, minimum of what it actually comes in at. So the balance as well of the WIP at the end of each of the taxation years, this is key, is valued at the lower of cost or fair market value. Okay, so again, another way to make sure that you're trying to minimize the impact or the hit is to potentially look at your WIP and value that at the actual cost, if you're actually tracking that. So, and I'm going to get to that in a bit. So who will be most affected of these professionals? So really, when you break this down, the people most affected are, I guess, with partnerships with multiple partners, but especially retiring partners, new partners, as well as partners who have quite a bit of volatility in their WIP from year to year. So for retiring partners, when we're looking at this, we're saying, okay, now if you retired in December 2017, then you're okay. You're not actually going to get hit with these new WIP rules. But if you're a partner retiring in 2018, you're actually going to have to pay tax on 20% of the the December 2018's WIP, which may be significant, saying here, depending on the volatility, right? So you're not getting that full deduction that you would otherwise receive. For new partners, or even current partners, but basically in 2018, you're going to get the add back of the full add back of 2017 WIP without a full deduction of 2018. All right, so think about this. If you're a brand new partner in 2018, how that might impact you. Because that decision on WIP, is not at the partnership level, right? So new and current partners are also subject to the transitional adjustment. They'll have a WIP inclusion, even if they did not claim the deduction in past years. And partnerships with significant volatility as well should, said you should talk to the tax advisors, but you probably have that, or you're probably your own tax advisor. But obviously for your law firm clients or lawyer clients, you're certainly going to want to stay on top of this and have that discussion with them. And by the way, and I'm going to sort of touch upon this, but one of the things that people should do is even see if they can address some of this in a partnership agreement to try to avoid some of the issues that can come across. And there's also some adjustments, but let's just go over a quick example. So you're an accountant operating as a sole practitioner. I listed WIP balances for the years 2017 to 2022. So that's 6 years. And then for illustrative purposes, I said just assume that the accounting, for accounting purposes, that the income is $500,000. And so this is how it sort of breaks down. And again, not going through all the numbers here, but as you can sort of see, you see, I guess, how the different income inclusions come to be. And you see because of the volatility in the WIP, how the taxable income is quite volatile as well. So that's certainly something to keep in mind as well, so for yourselves, but also for your law firm clients. And so what this example illustrates is a few things, but basically there was no impact in 2017, so the regular deduction is allowed because the transitional rules don't actually apply until 2018. And during the transitional period, the accounting income each year from 2018 to 22 includes the WIP at the end of each year. And the percentage of the WIP basically goes down. I guess the deduction is sort of reduced from 100% to 80%, 60 all the way down. And so basically by 2022, we're at where we need to be. We're past the transition. So WIP at cost. So I know not many firms do this. This is something that we actually, at our firm, we were sort of, we've always been looking at WIP at cost as well. So we certainly have WIP at our billable rates, but also WIP at cost, just for more managerial reasons. But that's going to be very beneficial and helpful, and I think a lot of people are going to, or should start considering doing that. And how are you going to track this? Because, and again, the cost, by the way, is not defined in the Act, but in summary, it's generally limited to salaries paid to professional employees that are expected to be recovered in future billings, including benefits. And does not, unfortunately, but again, this is not defined, but generally, general understanding is that it does not necessarily include any fixed or indirect costs, such as the rental, administrative, general office expenses, that type of thing. So it's pretty key that if you do have, and if you do have a significant WIP balance, and you can't just bill it all out, that you do look at the cost. You got to make sure that you're actually tracking that. Or fair market value, right? So fair market value is basically the amount that can reasonably be expected to become receivable, and that takes into account even the amounts that are collected from unbilled amount of the services rendered in the year. And in calculating the fair market value of the WIP, you basically want to analyze first of all, is there a WIP that will never be billed? So one of these things that we're going to have to do. Again, if you're a calendar year basis, is taking a look at this every December and saying, what on here can I not, or do I not expect to bill? I mean, or to collect, and let's actually get on this and write this off. Obviously you can still go to try to collect it, but let's not have it sitting here in WIP. So we're going to have to do a cleanup. And the other thing too is try to bill as much as you can. And I've talked to lawyers who basically said that. They sent out a bill with a letter that basically says, due to the tax changes requiring me to sort of take into income some of the unbilled time, I now have to bill you. And so, obviously not that you have to do that, but, again, how do you minimize this impact on you? So there's a few things, right? Bill all that you can, write off, anything that you should, and try to value it at cost as best as possible. This is done on the, saying here, I guess the overall value is on a job-by-job basis. Contingency fee arrangements. So for that, CRA has actually confirmed that until the right to collect an amount is established, the amount is not receivable. As such, no amount should be included for these fees in value and WIP. And income will be recognized when the right to collect the amount is established. So some takeaways and considerations for this. I think it's pretty key that, we have to start looking, if it's not already done, we have to track WIP by partner. And again, this is for us, and it's also for our clients, partnership clients. But track WIP by partner and adjust their income allocation accordingly. Maybe consider that, right? So in the overall income allocation by the partners, maybe consideration should be given to this. Reviewing the partnership agreement, as I mentioned before, to ensure that the effect of the changes in the treatment of WIP have been addressed. So, you may want to, again, seriously consider that. I always say it's easier to get an agreement together when everybody's, on the same page and no one's fighting, and to hopefully try to avoid a fight. Be more diligent in billing, as I mentioned, to minimize WIP at year end. And also, in the event of a sale or purchase of participation in a professional partnership, ensure the impact of WIP is considered in the price, if there is a price. And some final comments. Really, I think the big thing here is we sort of saw some of the WIP, and it was seeing the passive income rules and what they are now. Much better than where they were before. At worst, you've got somebody paying tax at the 26.5% rate. But if you've got a structure in place, if you don't necessarily need to take all the money out, then there still is a deferral opportunity there. But really, it's toasty. And I was having a conversation with our managing partner today. She was saying that she almost feels like she's been doing this for decades, and it's almost like 80% of what she knew is now different. It's now changed. And so she, maybe it's not 80%, but it's a significant part of what we do. And there's a lot of, we work with private business owners for the most part, and they compensate themselves and their families through dividends. And a lot of them actually do it not because they're rich, but they're looking for ways to try to mitigate some of the risks that they're taking, and sort of bring them to par on where they could have been otherwise. And so this is, again, unfortunately, something that we're going to seriously have to consider. I think we're going to be very busy this year and having a ton of conversations with clients, and the key is obviously trying to document this, because if this is difficult for tax professionals or accountants and lawyers to sort of follow, then imagine what the clients how the clients feel, right? And they're not necessarily going to remember why we're doing what we're doing, why we've changed things the way we've changed things, and why they're no longer able to pay themselves or their family member a dividend. So I think that's what's key. I don't know if Gavin, if you had anything else to add to that.
Okay. So I wanted, just before I speak, I wanted to mention it's a real privilege for me to be working with CPA Ottawa, for me to be working with Richard and Lisa in planning these events. I fundamentally believe that Ottawa taxpayers benefit from us having a vibrant and active association for tax professionals to gather and share ideas. I know I certainly learn a lot from presentations like those of Gavin and Chad, as well as Jacob at the last event. Because I'm so convinced that this is important, it does lead me and my law clerk to get a bit pushy when we're selling tables and tickets. I reread an email that I sent to Gary, and I realized that if I took out the words table at CPA event and replaced them with used Toyota Corolla, the email actually still read coherently. So we're pushing on you guys, but we do it for the right reasons, and if ever it becomes too much, just let me know. So this presentation is the tax dispute resolution and litigation update. As Beverly mentioned, this is an area that I practice in exclusively. This is all I do. I started working for Chief Justice Rip at the Tax Court of Canada, and I've been living the dream ever since. So the purpose of this presentation is to let you know, to help you help your clients avoid getting in a lot of these situations, or if they do get in these situations, to help your clients get them out of that as quickly as possible. So that's my objective for our presentation this evening. Okay, so our agenda, I'm going to start off by talking about two areas that CRA focuses on. We're going to do a deep dive on those, namely international assets and the underground economy. And then I want to cover so once we'll go deep first, and then we'll kind of scale back out and look at these issues in the broader context of the tax dispute resolution process. And then I'm just very quickly going to touch on the VDP process and the changes. I think you've heard a lot about those. And then I'll give more of kind of a newsy CRA update, some of the things that we heard in the news from and about CRA over the past year. So disputes regarding international assets. We know this is an area of focus for CRA. 3 years ago, it was the Panama Papers. This past year, it was the Paradise Papers. We know multinational corporations, Nike, Uber, Apple, are using tax havens to effectively get themselves considered to not have any residence for tax purposes. We also know that 7 out of 8 of Canada's biggest pension plan organizations are using tax havens. So this all came out earlier this year in the Paradise Papers. But before I get into, we also know that CRA is doing a lot to try and mitigate that, to curb that. They're buoyed by the $1 billion they received over the past two fiscal budgets. But before I get into kind of the nitty-gritty of what CRA is doing, I thought it would be helpful to look at a case that I've been working on recently to understand how this could affect your clients, how it affects real people, not just Nike and Uber and Apple. So I'm going to speak to you about the Smiths. The Smiths are Canadians. They're currently in their 70s. Back in the 1980s, they were working overseas. Mr. Smith's firm sent him abroad to work. And so they were over there for a number of years, so they became non-residents for tax purposes. While they were over there, a financial planner came over, a Canadian financial planner came over and spoke to Mr. Smith and his colleagues, and he convinced Mr. and Mrs. Smith to invest some of the money that they were making overseas in an investment fund. And it promised to pay in American dollars, and the Smiths were convinced that this would yield good returns. So over a few years with them being abroad, they invested $70,000 in these funds. When they got back to Canada, their understanding, they weren't particularly financially savvy. Their understanding was, well, I made this money overseas while I was a non-resident. I'm coming back to Canada. This money is in an offshore account. They didn't think they had to report it. So in 2015, 35 years later, they were assessed under Section 94.1 of the Income Tax Act. You may or may not have seen it. It's a hardcore provision. Hardcore is the right word. It's a hardcore provision. It's an anti-avoidance provision. It imputes income onto a taxpayer if they have an offshore investment fund property. So it takes a percentage of the money that was in this offshore investment fund, and it brings it back into the taxpayer's income each year while that money is offshore. It applies if, and I'm quoting from the Act here, one of the main reasons that the taxpayer acquired the property was to pay significantly less tax. CRA found out about this money that Mr. and Mrs. Smith had overseas, and they assessed Mr. and Mrs. Smith. They assessed them going back to 1980. They assessed them $50,000 worth of tax. They assessed them $180,000 worth of interest. Needless to say, I mean, the $70,000 had grown, but it was totally wiped out by this system. So, yeah, we settled it. So, fast forward a little bit. Fast forward through a lot of stress and a lot of work, a lot of energy. We were able to settle the file. We settled it in the end, CRA only got $13,000. Happy to report that Mr. and Mrs. Smith just yesterday received checks from CRA for $190,000, and they've got a bit more coming. All this is very good. I should know that we were really lucky to get a very good DOJ lawyer. He was reasonable. He saw that there were some issues with CRA's case on this, and he was reasonable throughout. What I was very happy about was that we were able to avoid discoveries. So you can imagine that the discovery process, this is when the Department of Justice lawyer gets to interview the taxpayer, it requires a ton of prep. It would have required a lot of stress for Mr. and Mrs. Smith. We were able to settle this before that even happening, which I think is a bit unique and quite positive. So we were able to do that. But all of this took place over the course of 3 years. I got the file at the appeal stage, so filing the notice of appeal. Even that, from that to settling it, took over a year. A lot of stress for Mr. and Mrs. Smith. They're an adorable couple, and I don't mean to be kind of dismissive or disrespectful in using the word adorable. They're actually adorable people. I would call them. I would either call them or email them every Friday to give them some sort of update. And when I called, oh, honey, it's Dean on the phone, and then she would like hustle upstairs, and she'd get on the line upstairs, and I'd say, okay, this is where we're at right now. This is the next step. You'll remember this. You'll remember that. This is what we're waiting for. Obviously, they're very happy it's over, but this is 3 years during the time of their retirement, where they don't really know if they have a retirement savings plan anymore. So, CRA. Speaking now about the specific actions that CRA is taking to address, the people who have their money offshores, Apple, Uber, etc. So CRA, this is coming from kind of CRA reports over the past year. They're increasing their use of big data. So they're going to be doubling down on that. They've received 5 recommendations from the Offshore Compliance Advisory Committee. That's the same committee that advised on the changes to the voluntary disclosure program. So this committee is also advising them on how to use big data more effectively. They're reviewing electronic fund transfers of over $10,000. You may have had clients that have received letters about this and want to know what this money is about. They're involved in the Common Reporting Standards, which this is a bunch of industrialized countries who will now be automatically sharing information, bank accounts, etc. So this will happen automatically. CRA is participating in that. They've still got this offshore tax informant program. And all this because they're predicting the $1 billion budget increase that they got will net them $5 billion in return. So obviously we want CRA doing these things. Obviously we don't want wealthy people hiring fancy tax lawyers, the ones down in Toronto, and then moving all their money overseas, and none of it comes back to our schools and roads and etc. But the takeaway from this is that, and the story of Mr. and Mrs. Smith is that these actions will eventually impact your clients. Eventually your clients will get caught in the crosshairs of these, and it's important that you know, and it's important that you take swift action, frankly. If you can do anything that's preparatory or do anything in advance, like inform them of some of the actions CRA is taking and ask them about assets that are overseas. There's always the voluntary disclosure program, which we'll talk to about in a minute. Obviously, that's very valuable service that you're providing your clients. With regards to the Panama Papers, just a quick note here. So, unfortunately, CRA isn't collecting much on those. So we had these leaks that were almost 3 years ago. We don't know what CRA has collected on that, and a large part of that is because the CRA isn't allowing the voluntary disclosure for people whose assets were discovered through the Panama Papers. So that's just a side note. The underground economy. So this is another huge area of focus. CRA has been very explicit in identifying this as a focus area for them. I think we know some of the usual activities, and if you're thinking about the underground economy, you'll think about things that are happening kind of on Craigslist or whatever. But there's also, obviously businesses that they consider to be operating in the underground economy by taking cash in and not reporting it. So the big ones, is restaurants, right? The big one seems to be, from what we're seeing on our end, is restaurants just getting hammered with these reassessments. So I'm going to talk about the Joneses here. This is another real life situation. So they were restaurant owners. CRA audited them. CRA took 3 actions with regards to the audit. First, they seized the Joneses POS data, so the data off their screen where they're punching in how much people paid for their meals. they did a 2-week observation at the restaurant, where 2 CRA officers are sitting there watching people come in and noting down whether they paid in cash or paid in credit or debit. And then they're doing a net worth assessment on the Joneses personally. So the Joneses were assessed the corporation was assessed, the individual was reassessed. I got this at the objection stage, and they were assessed 4 years back. The reassessment, this is a small restaurant in Ottawa, the reassessment was $900,000. Mrs. Jones told me this story once that like these people work incredibly hard. You'll know that the margins on a restaurant are very low. These people are working incredibly hard. Any email I get from Mr. Jones is always at 2 o'clock in the morning. When I meet with Mr. and Mrs. Jones, they always want to meet at 7 a.m. at their restaurant. I don't know when they're sleeping. The story that Mrs. Jones told me one morning when I met them at their restaurant was the night before they arrived back at the house, she's bringing stuff into the kitchen, leftovers or equipment or whatever to clean up. He was supposed to bring stuff in. 10 minutes goes by, he's not in, she goes back out and he's fallen asleep in the garage in his car behind the wheel. Thankfully the car was on. So they're working extremely hard. But you'll see in a second, Mr. Jones, unbeknownst to Mrs. Jones, was taking certain money under the table. He was deleting it off the POS system. So this is an abstract from the audit report. You'll see what CRA has done here is they've looked at the data they've pulled off the POS system. The orange line is debit, the red line is credit, the blue line is cash. You'll notice that when there's a bad month for all 3. When there's a good month for all 3. So CRA puts this in the audit report and says, this is what your POS data is telling us. This is what you reported. And so it's kind of funny, but I say it because if you're a business owner, you never think that they're looking at you. You never think that CRA is going to spend 3 months digging into your records. And you never think, when you hear about Apple and Uber and these companies in the newspaper, you just never think about why CRA would care about what you perceive as to be just kind of chump change. And that's what Mr. Jones was thinking, unfortunately. But I show you this because it's important that people know CRA is really good at making it look really obvious. Like, they do this all the time. There's people who specialize in restaurants. And so it's important to me that more and more clients and restaurant owners and all clients know about how willing CRA is to spend months on the file of Joe Blow the plumber or Mr. and Mrs. Jones. So how did the assessment break down? How did it get to that $900,000? Well, first off, they assessed the corporation. So they assessed the corporation income tax, gross negligence penalties, interest on both of those. Then they assessed HST on all this unreported income. So HST, gross negligence penalties, interest on both of those. Then they assessed the shareholders. Income tax, if you're concerned that it's the same income that the restaurant got hit with, you're right. Gross negligence penalties, interest on that. So this is a doozy, and as I mentioned, Mr. Jones did admit to me eventually that he was deleting some sales. He was using it to pay certain employees who didn't have work permits, or to pay for repairs where the plumber that would prefer cash, and so it gives him a deal. So he was doing these types of things. So how do you get the client out of this? Well, you're not going to get them off scot-free, that's for sure. What won't work in a dispute like this? Well, first, crying, oh, this is double taxation, won't work. CRA doesn't care, and the courts have said that they don't. Frankly, not that they don't care, but they don't care. You can't use the. If you're the corporation and you're filing an appeal, you can't use the appeal of a different taxpayer as your defense. And so the courts have basically said, yes, we know this is double taxation, but kind of, frankly, it's your fault. So Crying double taxation won't work. Claiming, oh, it was an unconstitutional search and seizure. So in this case, Mrs. Jones is working at the restaurant at like 8 o'clock in the morning, or probably 9 o'clock in the morning. CRA comes and taps on the window because the restaurant is closed. She opens the door, she says, we're coming to audit you. We're gonna plug into your computer system and take your records. So not the greatest start to an audit. But CRA has very extreme powers under the Income Tax Act and under the Excise Tax Act to take these measures to access businesses' books and records. If ever I get a file from a criminal lawyer, they'll always say, Dean, you're going to handle this in 5 minutes. It was an illegal search and seizure. Don't even worry about it. Unconstitutional. Unfortunately, that's not the case. These provisions of the Act have been tested at the Supreme Court. The Supreme Court has said this is fine. This is not a breach of constitutionality. So that's not going to get us anywhere. Relying on a credit in the shareholder loan account is also not going to get you anywhere. So a lot of people will say, okay, dealing explicitly with the shareholders, well, don't tax them on this. Don't double tax them on this income because the restaurant owed them all this money. In a lot of cases, that's true with restaurants, where people are feeding it, the owners are feeding the money. You don't get to say, oh, well, they had a shareholder loan account of $500,000, so this unreported income that you've assessed them of $500,000 was actually just the repayment of a shareholder loan. Unfortunately, CRA isn't going to go for that, and the courts have also answered to that too, saying, no, that's not how it works, and it's kind of obvious when you think about it, because then anyone who had a credit in the shareholder loan account would kind of be operating with this get out of jail free card. So they don't go for that. So what do we do? Okay, so what might work? Notice the word might. What might work? Well, the first thing is you've got to get to the truth on these things as quickly as possible. You never want to just start firing. I mean, a lot of counter arguments are going to pop into your brain when you see one of these files, when you see one of these reassessments. And you're right, we're going to talk about some of the counter arguments in a minute, and you'd be right to say, hey, well, what about this, what about that, what about that? You still don't want to just start firing off counter arguments before you've gotten to the bottom of it and you've gotten to the truth of it, because every counter argument that you throw that comes back as being not consistent with the data or not consistent with the evidence tarnishes that taxpayer's credibility even more. And as you can imagine, in a file like this, the taxpayer isn't starting out with a lot of credibility in the first place. So you need to get to the truth of that. For me, with Mr. Jones, I always met with Mr. Jones and Mrs. Jones together. We met the first time, didn't get anywhere with them admitting anything. Met the second time, didn't get anywhere with them admitting anything. Met the third time, I asked to speak with him by himself, and sure enough, then he discloses what was actually going on. So that puts me in a position to actually speak the truth and to make an argument that I know is accurate. Because the starting point, the amount that they got reassessed was just so high that I knew that CRA probably wasn't 100% wrong, and I knew that CRA probably wasn't 100% right. So justified deleted sales. So you can imagine in a restaurant where you have servers punching stuff in all the time, there's going to be stuff that they enter that needs to be deleted for good reason. The food got sent back, the server made a mistake, etc., etc. But when CRA comes and punches into the POS system and pulls out that data, they can't distinguish the justified reasons from the unjustified reasons. So we have to make arguments based on that. Now, Justice Smith mentioned the importance of documentary evidence that's credible and can be corroborated. In a situation like this, we don't really have it. The taxpayer has essentially tarnished all of that evidence. And so we have to make arguments there based on reasonableness, but you're not gonna, that argument alone isn't gonna get Mr. and Mrs. Jones out of trouble. Unclaimed business expenses. So here's where, we can be putting forward some evidence about, okay, there was this expense with regards to the plumber. Okay, there was this expense with regards to workers who didn't have work permits. Is this gonna save the corporation? No, the CRA is not going to write that off as income to the corporation, but it could save you money on the shareholder's personal side. So you're reducing the amount that actually went over to the shareholder. contrast CRA's different analysis. This is the most important one. So I mentioned that CRA came in, plugged into the POS system. That's one form of analysis. The other thing that they did was this observation. It's the second form of analysis. The third thing they did was they did a net worth analysis on the shareholders. That's a third type of analysis. And I really respect CRA for doing that work and not just plugging into the POS system and then reassessing them. The benefit to us is that rarely do those three match up. CRA is always going to assess you for the highest one. And so in this case, the POS, the data off the POS system has them earning this amount of income. The net worth side, which is restricted to the personal side of things, but obviously a lot of tax and penalties there. The net worth showed them only earning this much. So even in CRA's own documents, we have kind of evidence that they've provided to us that shows that these assessments on the personal side are out of whack. If CRA can rely on net worth analyses to assess people, they should also be reliable to drive an assessment down. And so we use the CRA's own net worth analysis as a basis, and then when we dug into that net worth analysis, we were able to show that a lot of transfers were coming from Mrs. Jones' parents. So we were able to further reduce that net worth analysis. So then the final thing is to discredit the projections. Projections are very frustrating when they're done with CRA. Typically CRA will only come in for lunch hour. So you can imagine that that's when typically the bills are smallest. The smaller the bill, the more likely people are to pay with cash. You compare that to sales in the evening when families are coming in, one parent is paying for the whole family. That bill gets higher, it's more likely to be paid in credit card. So CRA is saying, oh, because we saw so much cash coming in at lunch hour, that must mean that you're earning that percentage of cash all the time, every day, going back for the past 4 years. And so what we've been able to do is show the discrepancy between the cash in the evening and the cash during lunch. Now CRA says, well, you're using that cash from the evening, but we don't believe what that cash is. So then we go to the plastic data and we say, okay, you can dispute the cash, but you can't dispute the plastic. And we use the plastic, that's credit and debit cards, to show the difference between the sales at lunch and the sales in the evening. Starting to geek out a little bit here. I'm hoping I'm making it a little too technical for 8:30 on a Thursday night. Anyways, I get excited. So all that's to say, this file is still underway. Thankfully, I've got a very what appears to be a very reasonable and fair CRA appeals officer. We've saved them $600,000 so far. We're still working on it. There's a lot that we can't do with files like these. Obviously, Mr. Jones isn't going to come out scot-free on this. So because we were seeing many of these restaurant assessments, we did a net worth. HazloLaw did a net worth, an ATIP. So from the ATIP, we found out 60% of restaurants that are audited are eventually reassessed. Seems like a high number to me. The average restaurant, so these are just averages, but the average restaurant that's reassessed would have unreported income of almost $200,000 and would have gross negligence penalties of $16,000. So even just, these are crude numbers, but even just the crude numbers are pointing, are suggesting that frankly CRA is headed down the right path when they're focused on these restaurants. And so the takeaway here being, if you have a restaurant, do let them know that they are under the microscope. Just a couple other CRA actions with regards to the underground economy. They're seeking court orders from federal court to disclose information. So in 2000, we saw them go after eBay, get a bunch of data from eBay on who's earning money through eBay. We had a client recently walk through the door, a new client walked through the door with a $300,000 assessment from eBay. 2017, Square and PayPal, they got CRA got court orders to get the documentation on Square and PayPal. Square is the little thing you plug into your phone and people can pay you with Visa. So, people selling organic bread at the market or whatever. PayPal, I think you all know. In the future, could we see could we see CRA going after Airbnb, Uber, Skip the Dishes? I think we will see that. So another thing here to maybe alert your clients to. The postal code project, we saw news on this, CRA targeting affluent neighborhoods and then using the data they pull from those affluent neighborhoods to decide whether to do a net worth analysis or some other analysis. CRA has done that before, they've done that in the past, but they're now taking this to scale. They've never done this at this level, so CRA set that out explicitly. And then the usual audits of cash businesses, the usual net worth assessments that you and I all know and love. So we went kind of micro on international assets and the underground economy. I'm just going to scale back quickly and talk about the tax dispute resolution process as a whole. So I'd like to use this kind of visual to show what the tax dispute resolution and litigation process looks like. So that top arrow going across is your normal review/audit, which moves to an objection, which moves to judicial review in front of Justice Smith here. The next one, a fairness application. So that's when you're not disputing the tax issue, you're just asking for lenience for your client with regards to interest and penalties. You actually get 2 kicks at the can with CRA on those. And then if you want to, you can take it to judicial review. As Justice Smith mentioned, that doesn't go to the tax court, that goes to the federal court to decide whether or not CRA exercised their discretion properly. So the federal court can't tell CRA that they decided the fairness request wrong. They can only say, can you think about that again? You weren't reasonable about this, or you didn't factor in that consideration, or you weren't transparent enough with your reasons. So that's what you get out of a judicial review from the federal court. I can't say I recommend that to a lot of clients. It would have to be a lot of issue. I've had success one time with that, but for the most part, I don't like the idea of going to court and not hearing that we were right. Voluntary disclosure, I intentionally moved that arrow back. That's because obviously you have to do that before a review or an audit, or before your client gets assessed with interest or penalties. We'll talk about voluntary disclosure just briefly in a moment. And then rectification, we know the Fairmont decision kind of tampered the accessibility of rectification orders, but and I spoke about it last year, so I won't go in depth on it now, but if there is a document that you come across where there's a mistake in some sort of planning arrangement, rectification could be an option for you, so feel free to talk to me about that if ever the need arises. So voluntary disclosure program. Again, I think that this has been covered. We know that changes have been made effective March 1st. We know that there's now 2 streams. In one stream, you'll get access to larger reductions in interest, and you'll also get reductions in penalties. In the other stream, if you're a sophisticated taxpayer, if you've done this over multiple years, if you're using an offshore account, etc., you'll likely be put into that second stream where you're less likely to get penalties reduced, you're less likely to get interest reduced. So the only benefit there being that your CRA won't come after you with criminal charges. So that's going to make the VDP process more complicated. A lot of people think it's going to put a chilling effect on the VDP process. We're just going to have to wait and see. I think it obviously remains something that you should be prepared to discuss with your client and advise them on, because as you've seen from Mr. and Mrs. Jones and from Mr. and Mrs. Smith, the alternative is not good. I also wanted to alert you to this federal court decision with regards to GoatCA. So this was just decided recently, and CRA, in this case, someone made a voluntary disclosure going back 10 years, which is kind of the norm if you've had a long situation. Typically, typically professionals will usually say, okay, we'll go back 10 years, that's the max. CRA, in this case, used the voluntary disclosure to establish that there was a misrepresentation, and therefore they could go back past the statutory periods. And so they went back for like the 15 years before the 10 years, and they reassessed them for those years. The federal court said that there's nothing stopping the CRA from doing this. So tread lightly with the voluntary disclosures. Again, they're a very valuable tool, but you'll just want to be careful in how you're proceeding there. Very quick CRA update here. In many ways, it's been a tough year for CRA with regards to some of the PR they've received. I'm just going to go through some of it quickly, and then I will highlight a couple of positives as well. So first, the Auditor General's audit of CRA call centers. So this was a bad one. CRA has 9 call centers across the country. They're mandated with providing accurate and timely information to taxpayers. The Auditor General had a look at them, found that CRA was hitting its target of only 2-minute waiting time on the phone, but that's because 66% of people just got a busy signal or got a message sending them to the website. So the Auditor General was not impressed with the 2-minute wait time. And then, perhaps more disturbingly, 30% of the calls or questions that were answered by CRA representatives at the call centers were answered incorrectly. So that's unfortunate. CRA is going to be working on this, I expect. The takeaway here is, if ever you're getting information from CRA from a call line that you're relying on, ask for it in writing. They probably won't give you that, but at least make a good note of it. And what I try and do is I'll make a note of it. Lisa and I will put it in a letter, and Lisa will send it back to CRA so that there's a record of it going. So it's kind of like, okay, this is what I understand you to be saying. If this isn't what you're saying, please tell me now. And I think that would help if ever we got into a situation down the line. The Taxpayers Ombudsman to examine collections processes. This was a story by CBC where CBC heard about this guy in Newfoundland who had a coffee shop, had to close one of his locations because CRA came in and froze the bank account. The coffee shop owner, 2 days after his bank account was frozen, received a legal warning from CRA saying, we might freeze your bank account. So that was not helpful. And this led to a lot of more complaints, and so basically, the Taxpayers Ombudsman is going to be looking into this. This is really important. Lisa and I are doing more and more collections work. We're having more and more clients who want us to help them kind of negotiate the process. It is an ugly process for a lot of them. There is certain things that can be done to kind of ease the process. But if CRA comes in and freezes one of your client's accounts, it's very hard to get it unfrozen, and so again, you'll want to be ahead of the game on this one, be out in front of it. Disability tax credits, again, an unfortunate story where CRA, there was an internal memo that basically was telling CRA officers to reduce the accessibility of the disability tax credits to make it harder for people to get it, particularly with regards to diabetes. And CRA, the Minister of National Revenue was telling the House of Commons, no, nothing's different, and then they found out about this memo after. So if you do, and I got a call recently from a gentleman who his son had the disability tax credit. It affected the transfer of the father's pension to his son. In the future, his son suffers from schizophrenia, and it had been denied where it had been granted the past 10 years. So if you get one of these, do know that I think there's a good chance that you're going to be able to successfully dispute them. I think CRA will be walking this back a little bit. CRA malicious prosecution. This one just came out. You have probably heard about it. The BC Supreme Court awarding $1.7 million in damages to taxpayers to a couple who had been prosecuted by CRA for 21 counts of tax evasion, only for the judge to later see that there was essentially no evidence of this, and really disturbing emails going back and forth from CRA tax officials joking about these taxpayers getting the guillotine later after they had been convicted. So they got whacked, and rightfully so. On a positive note, CRA has announced that they're opening offices up in northern communities. In a previous life, I taught grade 4 for 2 years in a remote Inuit community, so I'm always happy to see where good jobs are heading up to the north to help those economies, so I was happy to hear about that. And also, CRA is taking efforts to facilitate women who are currently in shelters to help them file their taxes so that they can get any refund that they're entitled to. So also another positive for CRA.